pick up on some of the themes that Manoj introduced in his keynote and in the next panel session coming up now, where we're going to talk about scaling finance for energy and deep tech. And I'm going to hand over the moderation of this panel session to Kelsey Ems, the founder of Moxon Park. Please give her a big round of applause, please. Are you doing it? Please don't make me talk to myself. I'm happy to do it, but it'd be more interesting this way.
All right, everyone. My name is 𝗬𝗶𝗹𝘂𝘀. I run Tech for Net Zero. For those who know us, or those who don't know us, actually. We're a network of climate tech and deep tech startups here in Germany, in Austria, and Switzerland. We focus heavily on the political side, so exactly what our last keynote just spoke about, but also on the financing of basically when you move from your early stage seeds and then you want to scale. And so we're very proud today to be hosting a fantastic panel on basically how do you finance your scale up, how do you move from just pure equity also into credit and everything it takes. So with that, I'm going to hand over right away to our amazing panelists so we catch up on time. And Kelsey, over to you. Thank you.
Great. Thank you very much, Tobias. Hello, everyone. Indeed, how to finance a FOAC. That is going to be a term and a concern for pretty much everyone in this room, either through lived experience or through trying to define what exactly the valley of death is. That valley of death is that lovely place for founder companies that have managed to get venture capital and enough growth capital such that they have their amazing technologies that have gone to pilot, and now they need to figure out how to bring that pilot into a commercial facility in that first-of-a-kind FOAC. And of course, that's another lovely definition that lots of people have different interpretations of. But for the purpose of this panel today, we are going to be talking about exactly that, how we can be thinking about how to bridge that valley of death to move founder companies from that pilot into that first-of-a-kind commercial-esque type of facility. So we're going to be approaching now, that topic alone pretty much could justify an entire week-long workshop just to define exactly all the vagaries of the issues facing the Valley of Death. But we're going to approach it in a more bite-sized perspective for the purposes of this panel from the founder perspective. So, and exactly as Tobias said in his intro, thank you for that, is we will be looking about, okay, well, how do we then start to think about moving into the debt? Now, most founders are going to be very aware that they want and certainly need to introduce debt into their capital stack, but they perhaps don't know what type of debt, when to introduce it, how to introduce it, when they know that they're ready for it, and whether they're going to be told whether or not they're ready for it, and what's the catch? Because, of course, everyone's chasing a lower cost of capital product. What's the downside with that lower cost of capital? So with that, I'm going to introduce our lovely panel, who we're going to be hearing it direct from the horse's mouth, as it were. So we have credit providers here, both on the private credit side and structured products within investment banks. So I'm going to start with Marta, and if you wouldn't mind introducing yourself briefly, together with saying what makes your firm and product particularly distinctive. What problem are you solving for?
Sure. Hi, everyone. Great to be here. My name is 𝗬𝗶𝗪𝗂𝘀, and I'm part of private credit investment division at DWS Group. For those who are not really familiar with DWS, we are part, up to some extent, of Deutsche Bank Group. What we are doing right now, we are setting up a fund, growth debt fund, that specifically aims at first-of-a-kind technologies. We will talk about this more, so I can describe it in more detail later on. But yeah, really happy and very much, so to say, in our sweet spot, what we will be talking about.
Marvelous, thank you.
Got one. Thank you.
Good.
Very nice to meet you all. I'm Nicholas. I'm a senior director at Liquidity. Just to kind of give you an overview of what we do financing 5 to 250 million up to 5 years. Predominantly VC-funded companies, so we need a good growth track record. Yeah, and what sets us a bit apart, we are developing an AI tool internally to help our underwriting. So we do need a good track record of 2 years to do the underwriting. So for us, it's a bit of companies that have already a bit of a track record, and we essentially want to add fuel to it to have them grow faster, reach profitability. So.
We will be definitely coming back to some of those points. Okay, please, Felix.
Thanks. Thrilled to be here. My name is Felix. I'm part of BNP Paribas Growth Capital and Solutions team. So what we do is we bank growth scale-ups and startups in Europe. With we're 40 bankers in Europe, located in Paris, London, Berlin, and Frankfurt, with 10 people on the ground here in Germany. And what we do is basically, we want to be the one-stop shop for scale-ups when it comes to financing, but also with regards to other banking products, be it on the advisory side for raising equity, or also for day-to-day needs like cash management, guarantees. What sets us apart is that we can provide venture debt loans at an early stage, but are very happy to refinance this with more corporate-style financing tools once the companies are a bit more mature, so that you don't have to look for a new financing provider, basically. But for you, it's really a one-stop shop.
Perfect. And so we're going to pick up on some of those themes, including once you're up and running being one of them. So with that, we're going to launch straight into how we think about the capital stack itself and readiness for debt. So apologies, of course, pretty much I would imagine most people in the room will know the ins and the outs of how the capital stack looks, but just for the avoidance of doubt, we'll go through it quickly anyway. Of course, when we think about projects, equity comes in at growth stage. And of course, equity is less concerned, clearly, about the entirety of the risk over the life of a project. They want to see, and of course, not wanting to, I come from debt myself, so not wanting to speak to our VC friends, but of course I would imagine, we're all looking for those lovely growth curves, that famed hockey stick. And the actual risks in terms of how to price technology risk that hasn't been scaled, that is entry into a whole new market, isn't necessarily first and foremost in the evaluation of the company and what ultimately becomes the company's valuation. Now, of course, the founders themselves, as you all know, certainly that equity upside and the fact, forgive me, that they're willing to take that growth risk clearly comes at dilution cost for founders. So then how do we balance the other side of the scale such that there's less dilution for the founders, which clearly they want to continue running their companies and all the lovely things that come with that. Debt providers have a very different lens on how they evaluate a company and its project risk. So of course they are far less concerned about, and indeed often are going to curtail what a company can do in terms of its growth projects until there can be demonstration that the project itself has covered off risks known within the known unknown risk box, so that pricing can manage accordingly. So the way that they think about a project and the company is clearly very different along a linear pathway. So we're talking about exactly that valley of death where we've got somewhat proven technology. We have a pilot often, so we know that technology works at that particular scale. Now we're jumping somewhere between, often it's 5 to 15 times in scale to make the economies of scale work for that commercial facility. So how then do we translate that risk into a debt product that might be available? So with that, Felix, I'm coming to you first, exactly because you said when they're up and ready. So how would you think about a project and we're going to speak in project term here, likely rather than just company, but I leave it to you if you'd prefer to speak to company as well. What factors have to be there for you to be willing, you personally at BNP, to underwrite a project?
So what we are really looking at, of course, and I guess it's somewhat the same for the industry, is of course in the direction of contracted revenues going forward. So really once the technology is de-risked, so to say, are there clients that are willing to invest or take off the project in the future? And is this purely a matter of scaling, so to say, the project? So once the technology is de-risked, then we will be far more comfortable too.
I'm going to stop you there. When you say the technology is de-risked, does that mean you are satisfied with the proof of technology at pilot stage, or or is it only around those offtake contracts, which is the securing the revenue stream?
I mean, it's a highly specific question, or might be different from situation to situation. Of course, if we are talking climate tech startups and scale-ups, we're never going to be in a situation where the technology is completely de-risked. I mean, even if the demonstrator is running, it's still the question if the product will be working at scale, if there's a market for that, naturally. So, of course, this risk needs to be mitigated. For that remaining technology risk, we try to work with guarantees. We, for example, partner with the European Investment Fund to guarantee part of our exposure. So this can make us far more comfortable with regards to the remaining risk on the technology.
And sorry, I'm going to pick on you. I'm going to come back for one more because I know BNP very well from my past life at Stegra. In terms of how then your particular product, the sector in which you're working, compares to maybe a traditional project financing, because I'm listening with my project finance ears, and it sounds to me that that is pretty much the same quite conservative need to tick the boxes on de-risk before something would be considered bankable and therefore eligible for a debt product. So would you consider that your specific structured finance group has a easier in terms of check the box exercise than your project finance colleagues would?
Absolutely. I mean, but as you rightly say, it always depends also on the specific funding tool we are exploring with a project or with a company. We, in these early stages, even for ring-fenced projects, we are always going to take a look at the company behind, right? That's one that's key for us. I'm not sure if other banks look at it, but also for commercial reasons, because we don't want to invest our time in a project that then after a given period of time fails. Maybe we don't lose money, but we invested a whole lot of time and then the project doesn't come really to life.
And the project and the company behind, you mean above the project sponsor?
Exactly.
So the shareholders, essentially.
Yeah.
So the strength of the equity backing in the last round. Okay. Over to you, Nicholas. I'm coming. Same question. And I would really also appreciate some thoughts on how you consider any pre-completion revenue in that mix, and how you're thinking about what debt might be available and when such a project or company would be eligible.
Yeah, I mean, essentially all the businesses that we look at, right? Like if you look at SaaS businesses, consumer businesses, whatever we look at, pretty much there's always a component of something that was done before, but it wasn't core to the mission, right? So every business, I mean, we can think of the greatest unicorns. There was always some point where there was a fundamental change of the business, and the same can be applied to deep tech, climate tech, and so on. I've seen many businesses that have made decent amount of revenues with consulting activities, right? It's not core to the business, and you got to be cognizant that this will distract from the core mission. Very important, but it can extend your lifeline, right? And it can build a good revenue base, and then coming to providers like my fund is, we provide funding basis existing revenues, giving you another form of funding behind it. and essentially extending your runway and giving you more fuel for the projects to tackle.
Okay, so if I understand correctly, as compared to maybe more of a structured product coming out of an investment bank, you're saying there can be sort of side hustles that
exactly.
a company can, that as long as there's some churn in the business that is producing some revenue that is not core to the business, then how do you think about that additive core to the business? Because presumably to be able to underwrite, you need, I would imagine, same as any debt provider, and I will look to Marta in a second, that forecasted future revenues to be able to justify the debt that you're outlaying. So how do you fit the one with the other, I suppose?
How do you make it work? I mean, essentially, let's be real. I mean, like, from my side, how I would approach it is like, this company is able to generate revenues, right? And revenues with decent margins and so on, and that's where I put my trust at. It's not necessarily, is it this product or is it that product? It's just generally, how is this business functioning? So I just essentially give it a track record and say, hey, like, yes, this business has it. And let's say if the project doesn't go well, there's still, again, you can, focus on your consulting activities or whatever side hustles you might have, and kind of, extend your runway, right? Runway is most important, let's say, for me or probably most lenders. It's like, how does the runway work like? The same for the VCs, right? If the business is generating revenues, continues to grow, then I'm happy to add more equity to it as a fund, as a VC fund. And that's essentially what we're underwriting.
And so does it follow then that for more asset plays where there's actually the need for a factory before any of those sticky revenues, such as, we're hearing a lot at the moment, exactly trying to solve this, everyone's sort of conceptually thinking about, okay, well, I have to build a factory. I don't know how to build that factory, but once I've built it, I can make an asset co, and then I can cream the revenues off that. So if absent that recurring revenue, does that mean too early? Come back when you have recurring revenue?
Perfect question. Like something what we love doing is like financing assets as well, right? So if you have hard assets, it's not that we can essentially finance it 100%, but let's say, depending on what kind of machine it is, let's say 50%, we can add additional debt essentially to it, basis the revenues, and all of a sudden you have, funded maybe 70% of the project already by it, adding another 30% from the existing VC funds in the business, and your project is then well funded. That's the way to do it. We like financing assets. Let's be all transparent here. If the project doesn't work out, it is something that the business can sell on the secondary market and essentially repay us as lenders.
Yep.
That's why we like doing it.
Yeah, okay. I'm coming over to you now for your views, and I'm going to add an extra one. I would love your opinion on whether all debt providers essentially also think about risk in the same way, or whether there is the ability, based on what products you can bring out to market, whether you can conceptualize risk in a different way.
Sure. So I would say, for me, it's always about one question. That is, what's the timeline to revenue? And I think that summarizes also pretty much my colleagues here. So if the answer is not yet, right, then let's be honest, that in any shape, in any form, from any lender is basically the wrong tool, right? And that's where VC funding, so equity, where grants, subsidies, or anything of that sort should carry the risk. And the risk is still most likely, probably technology risk, right? When the answer is, though, yes, we've signed some contracts, offtake agreements, LOIs, then I think maybe all of us here would be happy to have a chat, but also that's where we at DWS focus essentially with our growth debt fund.
And when you say, so LOIs, so letters of intent and memoranda of understanding are sufficient for you to start thinking about a structured debt product? You don't need to have long-form agreements or something more binding?
So I would say it's always individual case. Okay. Really, it's case by case. I mean, essentially, like there's always one rule, like equity funds uncertainty, right, and technology risk. Debt funds or structures around any assets, any contracts, when you need capital to deliver, right, to meet demand, to scale, right? So that's where debt should come to play.
So indeed, so you would be interested at LOI stage, and I would be interested to hear from what sort of percentage of production capacity you're looking at, and whether it's as simple as translating it only to percentage. I imagine not, but I'd like to hear from the panel. And how do founders need to be thinking about showing that forecasted revenue? And you know, I come from project finance, where in the good old days, showing my age, when we needed the loan tenor plus a tail, so we had offtake contracts that potentially were 12, 15 years long. That is not happening in this market. So how do you also think about that then? Because LOI being non-binding, that seems extraordinary that you're willing to start having those conversations at early
I wouldn't
stage.
say that it's only LOIs, right? Like there is offtake agreements, binding offtake agreements, right? When you may have one industrial plant and then you start with another one, or like you want to scale, you want to change something. Maybe it's first of a kind, it's already up and running, but then it's second of a kind, right? So that's why I'm saying like it's always very individual, right? It's still bespoke financing, what we do at DWS, right? It's really individual case, and it's really tailor-made in that sense, right? But it's always about cash flow. So what we do, we underwrite to cash flows, not uncertainty.
Yeah, no, thank you, sorry.
I mean, I would agree absolutely 100%, and only add, in terms of like assessing contracted revenues, you might have a business where there's a huge amount of contracted revenues for a technology which is not yet 100% proven or deployed in a sense, so that you have these contracts locked in once everything is up and running. But if you're unsure on the technology risk, then you can't really, you need to discount also the contract revenues. I mean, I have a specific example in mind. Obviously, I can't share the name, but so in the end, it's as Marta said, for us also, it's very bespoke and depends on the situation.
Yes, that is both a politician's answer and a lawyer's answer. Being also a lawyer myself, I can understand. And unfortunately for the founders in the room, that regrettably, when you are moving into that more debt product type of a structured world, it really, as much as there are bankable principles and there are certain degrees of principles, it really is sort of pulling the holistic project into view. And exactly as Felix said, so how do you then therefore, what would we give founders as a piece of advice then as to when they would be ready to start having a conversation with any of you? I'm going to start with you, Marta.
So there's this phrase, right? Equity is expensive and patient. That is cheap or cheaper and unforgiving. So with that, I mean, it sounds like a warning, but it's not a warning. It's rather practical advice.
Yeah.
Okay? And really with that, just be thoughtful who your lender is, what time you introduce that, right? Because that's key, right? And maybe also just to say like how my fund differentiates from other lenders or from banks, right? We may actually step in a little bit earlier, right? But we will put more structure into that, right? So our structure, and that's always a key question also, like how you structure around the uncertainty or like around the future cash flows, right? Is also maybe like some grace periods, maybe milestone-based drawdowns, operating covenants rather than just financial covenants, right? So there may be like many different ways how lender.
We'll come on to how to structure for the downside.
The lender may get comfortable. But I would say be thoughtful who your lender is, and also that your lender understands your company, understands your cash flows, your revenue model. I think that's always the key.
Do you have anything to add? Otherwise, I might sum that up. Anything to add?
Maybe 2 points. First of all, how confident are you in your financial models, right? You know, when you're very much start out, right? You have ambition, you want to see how it works out, you know, but then you start operating, and then you gotta see how it plans out. Once you have the track record, it's much easier to provide debt to these businesses, and the process gets more competitive. You get better terms, right? And this goes on as you grow. Another point that I like to add is how much experience do you actually have with debt, right? I think we all can agree debt can be very dangerous, right? Like when a business goes into troubles, right? We come knocking, right? A VC fund might just add another more capital to the business, but we of course don't, right? We want our money back, I'm sorry to say. And therefore it's very important that you have the experience within it, right? So for me, sometimes I struggle if the founder starts running the debt process all by himself and is losing focus on the core business. I think that for me is a bit of a red flag. I would like to have a financial team in place that is able to take care of it. Obviously, the founder is part of this entire process, but he still has, time and focus on the core business. Yeah. So.
Anything to add, Felix?
Nothing to add. In a sense, to summarize, you should size your debt so that you're confident you can keep operational control in a downside scenario, right?
I think before we even get there, though, it sounds like from a founder perspective, parsing together what's been said here on the panel, in terms of actually approaching a debt provider, it sounds like there needs to be some degree of technology risk demonstrated that it's been mitigated, so either in a demonstrator or a pilot facility where nothing to see here, and you have hopefully a technical advisor that's also signed off on it. And it sounds like obviously directionally quite a full order book. I don't think we got to the bottom of what sort of numbers, because it depends on a case-by-case basis, unfortunately. But when the production capacity of the anticipated FOAC has been blob%, that there's a strong order book of customers either under term sheet, LOI, or ideally long-form agreement. It sounds like, and correct me if I'm wrong, then maybe that's going to your friendly local neighborhood debt provider and seeing if there's a conversation. It sounds like it's not too early in that sense, once you have sort of directionally some revenues that are forecasted under some form of contract, and then it's a relationship building, and presumably it's what happens then. So we're trying to give hope of when, appreciating that these are highly structured products, like when can they say that they're ready? It sounds like those are two important milestones. And is it harmful from a relationship building perspective to come too early?
It's never harmful. Yeah. I think, some people say that debt is dangerous, right? But I would say premature debt is dangerous, right? But when you have a conversation, right, with like all of us, we also kind of partially act as financial advisors in a way, right? We work together on structuring something, right? Like what Nicholas mentioned, you actually speak with a founder. Maybe he doesn't even have a finance team, right? Or only interim CFO, right? There are so many cases, right? And our point is is really to support with that in that sense as a financing form, right?
Yep.
I would say also people say VC, choose your VC investors wisely, because it's like a marriage, and maybe we are not, that we really for some time, right, in that game for specific time period, but still it may be the most crucial time period in your company's journey, right? Yeah. So just be thoughtful, choose wisely, and also have a conversation if it's too early. From your perspective, and maybe it is too early, but it's always about planning and future developments.
There were some great points in there that I want to pick up on, because I think that, as we hear from this panel, not all debt providers are created equal in that sense, and each will have slightly different products available at different stages and different risk appetites within a band, right? So I think then I'm going to come to you, Nicholas. How then are we thinking about the different types of debt products that could be available? So obviously, presupposing that the preconditions have been met and there is an initial conversation that a founder has come to you and said, okay, so here we are. What can you offer us? We have some side hustle revenue. We have really good visibility on full-term revenue.
Starting to
we want to build a big plant.
Side hustle.
Yeah. Yes.
I mean, again, like I think that's why like choosing the right partners in your cap table is very, very important, right? I have seen VCs that you know, in terms of debt, have made terrible decisions and pushed the wrong structures on businesses. I think I just want to add that we love consulting businesses, right? Like there's never too early to have this conversation. It's my favorite part of my job. So I just want to add that. And that comes to the VCs too, right? Like jumping in and, you know, a founder who has done, you know, great stuff around PhD projects and so on, and all of a sudden it's like, debt, never dealt with it. It's very important that you have a VC that is like, we have done this before. These are the funds that you can trust, have these conversations, and maybe the fund themselves actually joining them. I think therefore, you know, my fund, and I think most others, do take, you know, consideration which fund is in the cap table. It does play a bit of a role, while financials are most important. But, you know, if you have some great VCs in there, we know that the business is taken care of in a downward scenario where, you know, you need to call upon your investors to add equity, new cash to the business. We can trust them. Yeah, so that's the way that we do it.
Yeah, I'm going to talk now cognizant of time, and we hopefully will get some questions from the audience. I just want to talk very briefly about solving for the downside scenario. So exactly as both Marta and Nick, well, everyone on the panel has basically flagged, is debt can be dangerous in the sense that whereas equity, well, okay, they either let you flop or they inject more money, debt will need to exercise somehow to get their money back. They want their money back. So even though it is a cheaper cost of capital, it still comes at a cost, and that typically comes with exactly in this structuring phase, and depending on what product will ultimately be most relevant for you, which is why it sounds like do your shopping, speak to several debt providers and see how they can help structure a deal that works for you. But part of that structuring obviously will be slightly different viewpoints on whether they are mostly optimizing for that forecasted revenue potential, or are you solving for downside risk? So what does that mean in terms of obligations on the company, restrictions in the form of covenants, what you can do, what does the security package looks like? I would love to hear from Felix how BNP approaches that problem.
Yeah, I mean, again, to start with, it depends a bit on the situation. If we are talking about like a venture debt deal, we oftentimes work with minimum cash covenants, which sounds a bit counterintuitive in the sense that you are like lending money just to then have it as a covenant again. But the idea here really is, alluding to what Niklas already said, you want to have some time, right, to work out the situation so that you're not like hitting the wall with 200 miles an hour. But in the ideal scenario, right, you come together with the management and you find a solution. And this solution can again look very different depending on the situation. As you said, debt is an instrument where investors, banks want to protect the downside. So in the if it's possible to get the money back quickly, then banks or funds will do that. And of course, there's also the possibility to look at any collateral in the transaction and see how this can be used to recoup the money. But we like working with minimum cash covenants because for venture debt it gives some time to negotiate and come to the table.
Yeah, and that basically, to translate that, essentially means that there's going to be lockups on any cash that's coming into the business is going through one of those lovely cash waterfalls with equity coming out the very last for any dividends because they want their money back. Appreciating that we do want to save some time for questions, I would love from each of you, what do you think is the biggest founder misconception of debt? Where did they get it wrong about what debt is?
I would say confusing technical validity, technology validation with bankability, right? When you think of like, okay, there is a pilot plant, it works, it doesn't mean that you're already like bankable, right?
Would you mind giving me your definition of bankable?
I would probably say, with my previous experience also at banks here, that's why I also know the colleagues here. I would say bankable is when you really have probably double-digit revenue, it's growing very nicely, strong revenue, probably you're already cash flow positive or EBITDA positive many cases, right? Like it also depends on a bank. But I would say also you're rather like independent from your investors and from that equity or funding or debt financing gap, right? Like you can just basically base anything, any type of financing fully on your cash flows, right? Like current cash flows, not future cash flows.
And therefore, the bank is willing to underwrite that project on the basis of those,
and then bank
Hence
will
bankable.
underwrite current cash flows, right? Without all those predictions, right? Without maybe with like more simplified structure and so on.
Yeah, wonderful. Nicholas?
I totally agree with all those points, so it's kind of hard to follow up on that. Maybe different one, downward scenario is bad. It's a bit funky, but I think the best cases that I've ever dealt with were downward scenarios where the founders and the team around them approached us openly and said, hey, we have an issue, how do we resolve it? And coming to a table and finding a good solution, right? And these turnaround situations are the ones that work out best, so maybe add that.
Well said, yep.
I agree, I would maybe add that, it can be a lot of work to entertain debt providers in the sense that they will also ask questions, right? They will want to have calls, they want to like be informed, and of course it's good to get additional funding from a debt provider, but you should keep in mind that it's not like once the deal is closed, you see again in 5 years. But it's continuous work and
it's a marriage, as
absolutely.
Yeah, continuous work. Okay, marvelous. Well, appreciating we're at time. If there were any questions in the room, we have some phenomenal people that would be able to answer. I can't see anything. There's a bright spotlight, but otherwise, well, missed opportunity. With that, I think we'll close out. I'll thank my fabulous panelists for their views. And it sounds like visit your friendly neighborhood debt providers, if in doubt, and see what bespoke structuring might be applicable to you. And thank you very much for your time.
Thank you.
Thank you.